Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 138 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark. Welcome back.
Thank you. It's good to be back. I've missed you over the past couple of weeks.
I missed you as well. We had some good guests, but it's great to have you back.
I know, but as always, we're getting good feedback from people about the other guests on the show, so maybe that should happen more often.
I totally agree.
Before we begin, as always, just wanted to take the first few minutes to recap the performance for the month and the year of the major indexes that we track, and these numbers are as of the market close on February 24th. So we'll run through this really quick and then get to probably the main meat of it that people want to hear is what's going on with Russia and Ukraine.
Sure.
S&P 500 index down 5.18% for the month and down 10.17% for the year. The Dow down 5.6% for the month and down 8.7% for the year. The NASDAQ Composite Index down 8% for the month and down 12% for the year. IWM ETF that tracks the Russell 2000 index down 1.6% for the month and down 10.97% for the year. Vanguard International ETF down 3.77% for the month and down 6.5% for the year. 3-year T-bill yielding 0.23%, the 2-year Treasury yielding 1.6%, and the 10-year Treasury yield is sitting at 2%. Obviously, big news from this past week, Matt, is the market is focused on determining the economic fallout of the Russian invasion of Ukraine. This is a very, I think, fluid situation right now where, yesterday was different from today, and I'm sure tomorrow is going to be different from today. So as of yesterday, it was, invasion, military operations. Today, people are saying that the capital is going to get taken over. So what do we make of this?
My 2 cents is we got to take a step back and think, how is this going to affect the stock market? And stock market movement, a lot of it is predicated on revenue and actual earnings of these companies that we own. So I think people need to take a hard look and think, how is this really going to affect the investments that I own and their profitability and their revenue? And I think once people start kind of walking down that rabbit hole, they're going to figure out that a lot of what's going on, and I'm not trying to minimize the humanitarian impact of what's going on, but at the end of the day, how much it's going to affect XYZ companies' actual profits probably is a lot different from how their stocks have been acting lately. Mm-hmm. There's a dislocation between the perception of the state of the economy or the state of the world than actual underlying performance. Now, you're going to have things that are going to be more sensitive to this. So whether it's going to be investments that have a lot of exposure to their revenue to Europe, that's going to have a lot bigger impact than a company that has a lot of their exposure to the U.S. So again, I look at it from the economic side of the equation, from how it's going to affect these stocks. Short term, you're going to have a lot of volatility and emotion trading in the market. And then as the dust settles, that's when the fundamentals come back and people start really assessing, is it going to affect the things that I own?
Right. And I think people were a little shocked with yesterday's market action where, we opened down, 2 to 3%, depending on what index you were looking at. And then, these things reversed throughout the day and kept getting stronger and stronger. And all the major indexes finished, well into the green for the end of the day.
Yeah, I want to say the intraday reversal from the very, very bottom for the NASDAQ was about 6.7%.
Yeah.
That's a massive, massive move. And I think, and I don't want to get too far ahead of kind of the news cycle that I think is going to happen over the next couple of weeks, But at some point, I think the question is going to be raised, how much did the market discount uncertainty in January and February? Uncertainty related to the Fed, uncertainty related to inflation and supply chain. And I know during this podcast, we're going to talk about some of those items, but now you can lump it in and say, okay, well, how much have these stocks have discounted? Now you can add Russia-Ukraine uncertainty. How much of these stocks already priced that in?
Yeah, and my argument, which I think I'm going to make here in a little bit, is a lot.
Yeah, and when you see those types of move like yesterday, I mean, it kind of made me think, what does the market not like? It does not like uncertainty, and pricing that in is very hard for the market to do. And that's what really started the sell-off in January, was the uncertainty surrounding the Fed. If I were to be critical of the Fed year to date, where I really think they failed is in communicating their thoughts and guidance on rate rises at the beginning of the year. And that vacuum allowed people on Wall Street to come out and provide very bold predictions on rate rises this year, 7, 8 rate rises. And as people started to price in, that's a possible scenario, that's what started this sell-off at the beginning of the year. You fast forward to today, now you can lump in, Ukraine and Russia to this basket of things that are there, the market's uncertain about. And I think when you start looking at that, people might start to realize market and these stocks might price a lot of this stuff in already.
Mm-hmm. Yeah, and I like what you said. I think a lot of the selling that has taken place over the past couple of weeks is very emotion driven.
Very emotion driven.
I think we're starting to get to the point where the selling, has gotten to the point where it's very disconnected from these individual companies. It's not that there's necessarily anything wrong. A company could have, I was just talking to a client the other day, and he works for a publicly traded company. He was like, Mark, we just had record earnings and record revenues, and they sold our stock off by 10%. And I'm like, it's just a disconnect. It's fear selling. It has nothing to do with the company.
No, it doesn't. And I think, what you're going to find is the market, people like to think the market's efficient, right? This is why, the indexers, people who are really dedicated to indexing will say, the market's efficient. Look at the action just year to date. It's not efficient. And we are not going to go away anytime soon from the emotion of fear and greed dominating the markets. And right now, fear is dominating this market. And could it be irrational that people are there are people out there I know who are probably liquidating their portfolio over short-term events. And then I think, again, as the dust settles, several weeks from now or months from now, and you're really looking at how that's going to impact earnings, my fear is a lot of these people will end up buying back in at a lot higher prices. That's my fear.
Yeah, again, and it's not that, again, from a humanitarian standpoint, this is tragic. It's going to be tragic, and there's going to be lives lost. Absolutely. And no one wants that to happen. But, if you're, and I don't mean to sound insensitive when I say this, if you've been looking for a sell-off for the past 2 years, here it is, right? Here's your fat pitch. Not saying that it can't go lower from here, but we're more than 10% off the highs now.
Yep.
Haven't had that in a while.
Nope.
Fear presents opportunity, and, it's part of our jobs. And I think it's everybody, who's the DIY investor. It's part of your job to set emotion aside and humanitarian aspects aside and say, what do I need to do right now?
That's right. Because when people are making those emotional decisions to sell, the psyche of that decision for them is, this is going to continue. This is not going to get better. This is going to get a lot worse. Is that possibility? Absolutely. But it's like that any day in life, So if you start really thinking longer term about it, most investors aren't putting money into stocks that they need in a month, okay? Or
Right.
even 6 months.
Right.
You got to be looking at those timelines. And if you're looking for an entry point, as you were kind of indicating, is now the ultimate bottom? Could
Maybe.
be, could not be. But you're probably in the vicinity after this sort of correction. and my perception of underlying fundamentals are still pretty darn good.
Right. Right. And again, it's another good time to, to have a plan where, if you're one of those people that is waiting for a sell off, you should have a plan that, every 10% you put more money to work. If it goes down 10 more percent, put money to work, or 5% or whatever that is.
Whatever your number is.
Or else you're never going to get yourself emotionally to be able to do it because you always think it can go lower.
That's right.
So
no, I'm glad we addressed that off the get-go.
Yeah. Last thing, piece of positive news, Matt. Q4 GDP was revised higher to 7% from the original estimate of 6.9%. And this past week's initial jobless claims came in lower than expected at 232,000 versus 240,000 estimates.
Yeah, I mean, again, my theory is in order for inflation and the supply chain to improve, the key is employment. Mm-hmm. And what I want to see is when this employment number comes out for February and March, I want to see at least 400,000 new jobs. I would love to see that. And I think we're going to continue to dig out of this backlog, which will have a direct correlation to inflation.
Mm-hmm. Yeah.
My 2 cents.
Yep. First thing I had this week, Matt, was a tweet by Alvaro Elvidio, and he tweeted this chart, and I'll have Jenna post it onto our YouTube page, or you can check it out on our show notes at Jessup Wealth on Twitter or Jessup Wealth Management on Facebook and LinkedIn. So he showed 5 charts, Matt, and he tweeted by the invasion. And he showed previous invasions and how the S&P 500 has reacted to that. So the 5 different invasions he portrays here with the chart of the S&P 500 during those times is the Vietnam War, the Gulf War, Afghanistan War, Iraq War, and the Crimean Crisis. Okay? The point here that I want to make is that similar events to this in the past have not necessarily caused the market to fall apart. And would anyone have thought that previous wars would coincide with stock market gains? I would argue no.
Most people no.
Most people would be like, this is bad for the stock market.
Yeah, because I think what they're thinking is through the lens of a consumer. Though consumers might pull back on some spending, the industrial side of it ramps up big time. Mm-hmm. And so I think
it's rotation, right?
Yes, they look at through the lens of the consumer rather than the other positive economic effects.
Right. So an example, the Vietnam War, Gulf War, Iraq War, and Crimean Crisis, they all coincided with stock market gains. Afghanistan War, the market continued to move lower.
Yeah.
The other point I want to make here, Matt, is that, like we kind of touched on earlier, in most of these examples, there was selling before the invasion in the S&P 500.
Some telegraphing.
Yeah. Weakness like we've seen over the past 2 months. So if you look at these charts prior to the invasion, what's highlighted in gray, there was some stock market selling similar to what we've had.
Absolutely.
Okay. So the question, and I have my opinion on it, but I think it is already, this Russia-Ukraine crisis is already baked into stock prices. I think that if you want to sell now, you already missed the opportunity and you should have done it earlier in February or in January. Because doing it now, I think, is going to cause more harm than good, because we have to remember that the market is always forward-looking. And I believe this stuff has already been priced in.
You make a great point, and I absolutely agree with that. I mean, you're at the time, especially with the market's reaction yesterday, all of this uncertainty outside of Russia, Ukraine, again, add the Fed in, add the inflation, supply chain, employment, all this was really starting to hurt equity prices year to date. And the market does a good job of overshooting usually. It overly prices in negativity. And that's what causes these dramatic rebounds, these V-shaped rebounds. And I'm in the camp that a lot of this uncertainty, because remember, at the end of the day, it's all about earnings. And I think that a lot of these companies underlying are doing very good. Mm-hmm. And there'll be areas geographic areas around the world that'll be more hit in their economic activity, i.e. Europe.
Yep.
But big picture, I'm just not seeing the sell-off in these prices equaling most likely the hit to either the revenue or profits. I think there's a disconnect.
Right.
And I think the market's gone too far in general. And as the dust settles, there's an immense amount of cash on the sidelines. And just like we kind of saw into the close yesterday, we'll see it in a bigger picture. You know, people might not think we could see panic buying anytime soon. I beg to differ.
Yeah. Yeah, I agree. You know, and we can't rule it out that it's going to continue to get worse. You know,
absolutely could.
A development that would not be good, in my opinion, for the global economy is if China took this as an opportunity to do something with Taiwan.
Yes, I think that would be a game changer.
That would not, would not be good. And I don't, you know, because everyone, you know, we get, you know, flack for always being super rah positive here. That's one thing that would not be good.
That would be massive risk off.
Yeah. Next is a article that was written in the Wall Street Journal titled AT&T sets Warner Media spinoff plan and lowers its dividend. So AT&T said it would roughly half its dividend payout and divest itself of its Warner Media division through a spinoff. After the spinoff, AT&T said it expects to pay an annual per share dividend of about $1.11, down from its most recent $2.08 level. The new payout would cost the company just under $8 billion a year, down from the roughly $15 billion paid out in 2021. AT&T is one of the most widely held U.S. stocks, and the company has historically offered one of the largest regular dividend payouts on the market. Based on Tuesday's closing price, it had an 8.52% dividend yield. And you know, this is a thing that I want to come across, and we've talked about it before, so I don't want to beat a dead horse again, but you always got to beware of this stuff, right? So dividends are never guaranteed, no matter how good they look on paper. And if dividend yields look too good to be true, they usually are.
That's right. I mean, when you start to see, relative to whatever interest rate environment that we're in, you start to see those dividends get that high. The market is telling you something. The market is telling you that that dividend is not sustainable.
Yep.
Okay. Because if it were, the stock price wouldn't be where it's at. Mm-hmm. That's just the reality of it.
Right.
Okay. Now, what I will say is that historically, companies that pay a higher dividend tend to be a more mature company in their life cycle. They tend to have limited growth opportunities. So in order to appease their shareholders, they return any excess earnings in the form of that dividend, right? Mm-hmm. But when you have companies in these mature cycles that have competitive threats against their main business, like AT&T has, I mean, they cut their dividend a year ago, I think, or like 18 months ago. Mm-hmm. And so, you know, you really kind of have to question, is there going to be another? Because you might look at it and say, well, you know, okay, they cut it to paying out $8 billion a year or $1.11 a share, cuts that dividend in half. Yeah, four and a quarter is still a good number. They could cut it again.
Yeah, that's an example of a company that is just
fallen,
debt ridden.
Oh,
so
it's fallen hard,
right?
I mean, you're talking over $100 billion a debt.
Yeah, and in a good way. I mean, for this example, it's like, okay, look at the company's earnings and look what they're paying out in their dividend, right? And the question you have to ask is, did their earnings cover their dividend? And if not, the dividend's going to get cut eventually, right? And the same with interest payments. You know, are their earnings covering what their interest payments are? And the same thing, like that's not healthy, right?
Yeah, I mean, think of it also this way. They got to service that debt. They have to appease their shareholders. And in addition, I got to have some money to stave off these competitive threats that I'm now seeing. Mm-hmm. People are taking my clients.
Yep. Yeah, it's an interesting situation.
They're fighting a multi-front war.
Yeah, and I just encourage people, I would say, you know, focus on companies that are now increasing their dividends to, you know, their argument is, you know, to combat inflation, we're increasing dividends to reward shareholders. Focus on those companies, because companies now that are increasing their dividend, even though it's going to be a smaller yield than an AT&T, my opinion, it's worth it.
Yeah, and so to kind of round this out, I mean, even though Mark and I are appearing, negative on this specific example, this is not a recommendation for or against AT&T, because as we were talking about the market discounting this, the market might have overly discounted what we're saying, and this might be a good entry point in the name. Right. So that's what makes the market, right? And so ultimately, not a recommendation for or against AT&T, but ultimately, a lot of high dividend stocks could be traps.
Yeah.
And be careful.
Yeah, absolutely. It's a good way to say it.
Okay.
Last thing I had was try to lighten the mood here. It was a fun article from the Wall Street Journal that talks about which used car models have increased the most in price over the past year.
This is going to be interesting.
Yeah. So
Is my Honda Odyssey on the list?
No, it's not.
Yeah, that's a bummer.
But another minivan competitor to the Honda Odyssey was number one. Tipped the scales at number one.
What was it?
The Dodge Grand Caravan was up 69% from January of 21 to January of 22.
Are you kidding me?
Yep. The second was the Nissan Versa that was up 66%. The Toyota Prius was up 61%. Kia Forte up 58%, and the Volvo S60 up 56%. So, in my opinion too, Matt, this makes sense, right? There's more demand for those priced cars, right? It's not like there's a higher demand for Audis and BMWs.
It's those price points.
Right. So, in my opinion, it makes sense, right?
Yep.
People have more money in their pockets. People are having kids, have families, need that minivan.
And I mean, just demographically, after, COVID hit, you got people moving to the suburbs. You got demographics where millennials are having kids, and all of a sudden, it's not as fun to, take your kid and walk 3 city blocks to go to the park. You want to go in your own backyard.
Right. Exactly.
So all those aspects are playing into this.
Yeah. So I just thought that was interesting. I wouldn't have guessed that the Dodge Grand Caravan
I would have not guessed that
was the highest increase.
I didn't see
price.
that coming.
No.
That was not on my bingo card.
No, me neither. I'll turn it over to you.
All right. Here's what I got this week for the listeners, Mark. First is my topic of the yield curve flattening. Okay. So this is a piece from Top Down Charts on February 15th. So I'm going to take a step back and explain
what the yield curve is.
Yes. So what is the yield curve flattening? So a flattening yield curve may be the result of long-term interest rates falling more than short-term interest rates, or short-term rates increasing more than long. A flat yield curve is typically an indication that investors and traders are worried about the macroeconomic outlook. One reason the yield curve may flatten is market participants may be expecting inflation to decrease or the Federal Reserve to raise the federal funds rate in the near term.
Right. So just as a reminder, you get paid for going out on a time horizon on holding debt, right?
You get rewarded with higher interest rates to lock up your money for a longer period of time.
Right. So if you buy a 30-year U.S. Treasury bond, you're getting, in a normal environment, you should be getting paid a higher interest rate than you buying a 2-year Treasury bond.
Absolutely,
right?
Because you're taking the risk of, in essence, that interest rate's not going to change for 30 years.
Right. So when you say the yield curve flattening, you're talking about, one or two things of happening. Long-term rates are coming down, or short-term rates are going up, or both.
That's right. So there's not much difference between, say, a 2 and a 10-year Treasury.
Right.
Okay. And this is not maybe a popular topic right now in the market, but I think it's a real possibility that this yield curve continues to flatten. Mm-hmm. Okay. So what kind of prompted me to bring this up today is a chart, again, by Top Down Charts, and it shows the sources B of A Global Fund Management Survey. And it shows a percentage of mutual fund managers that expect yield curve expectations either steepen or flatten. And we are at a point where a lot of these managers are starting to turn and thinking the yield curve is going to flatten. And so here is my 2 cents on this. While most investors feel interest rates are going to rise, though it's very possible, Mark, I want to introduce this concept. It's going to be interesting once supply chains begin to improve, and assuming inflation starts to come in, how many rate rises the Fed will actually have to do. And that might be less than what Wall Street is expecting. Now, I prepared this before the news flow of Russia-Ukraine. And my perception is that yesterday, people are feeling that this provides a little bit of cover for the Fed. They're still going to most likely raise interest rates several times this year, but maybe not as quick, depending upon how events unfold and how employment numbers unfold and et cetera. But what I'm trying to get at is I think some of these bold, grandiose predictions in January of 7 or 8 rate rises, though it's possible, I think is becoming more and more unlikely, and the market would welcome that.
Yeah, I think you're right on point there. Yeah, I mean, the yield curve has been flattening for a little while now. So there's a lot of factors that go into it, right? It's not just like that you can look at one thing and be like, yield curve's going to flatten and then invert, which means short-term rates are higher than long-term rates, and that's not good.
That's not a good factor.
Right? That's one of the economic indicators, I think, and don't quote me on this, I think has predicted every forthcoming recession.
Yes.
Not timing, but it's preceded every recession, right?
Yes. Yes.
Specifically, the 2-year Treasury yielding more than the 10-year Treasury U.S. debt. Right?
Exactly.
Okay.
Exactly. All right. So my next kind of theme I want to explain to our viewers and listeners is liquidity. Okay. So a big problem in the market in especially February, but also parts of January that no one's really talking about is liquidity. Now, there was a tweet by a trader I follow. You gotta my traders I follow, they're great, man. This one is Fading Rallies, at Fading Rallies. He posted this on February 17th. This trader has over 28,000 followers, right? So this was what was written, and he had a chart from his Bloomberg terminal that he posted with it.
Okay.
He said, equity market liquidity has absolutely collapsed. Markets entered a new volatility regime following the volume-geddon. Evaporating liquidity reflects this. Volatility is expanding, and this is just the systematics pulling. Bids are vanishing, and real deleveraging will trigger feedback loops. So let me kind of explain what that means. Okay. There has been a lot less volumes in the market. Less volumes and less liquidity is going to cause more volatility, because it would be no different that if you had people, at an auction and most people were bidding on something, you're going to have more true price discovery. The more people that are buying and selling something, in my opinion, you have really true price discovery involved with it. When you have less people can sit there and say, well, I'm not going to pay that price. I'm only willing, if the stock's trading at $10, I'm only paying $9 for that. And when you have that lack of buying and sellers in the market, it's going to make the bid-ask spread, what someone's willing to sell it for and what someone's willing to buy it for, those are going to expand, and that's going to cause volatility to really go up. And I think what you've really had in February and March, plainly put, is you've had a buyer strike. You've had a lot of sellers, not a lot of buyers, causing these prices to come in. And it doesn't necessarily mean that these stocks are truly reflecting the underlying fundamentals in the name. And so I want to point this out, that volatility is caused a lot by the lack of liquidity. And remember, this could happen to the upside. So if and when the market turns, in the short term, and you have a lack of sellers and a lot of buyers, you could have some pretty violent gaps. And I just want to throw this out there for people that are attempting to time, I'm out of the market, I'm going to get back in when things are better. Just be aware that you could have some pretty violent up days in this market.
Yeah. And another thing that I'll throw in the feather of the cap of people that are like, you guys are always rah. This is concerning, right? When there's liquidity crunches,
it's very concerning.
It's not good. But the other thing I will say is, I'd like to see this chart on like a 20-year basis, because this only goes back to 2017.
Correct.
And since 2017, we've been in a declining liquidity environment, right? But returns have been fine since then on average, right? So I'm curious to see what this looks like on like a 20-year chart, because liquidity has been decreasing for the past 5 or 6 years and returns have been fine.
Yeah.
Now, is that signaling that something in a couple of years is coming that's big? Maybe. I don't know. But it's concerning when there's a heavy imbalance of buyers and sellers. That's not good for market operations.
It's not. And again, just like I said, you've had, in essence, a buyer's strike year to date. You could have the opposite, a seller's strike, in essence, really going to cause prices to go up, hypothetically, in my example. That's not a healthy market. I don't like to see that.
No.
Okay?
No.
So it is something that we watch closely, but I think it explains why the market had some of the movements it had in January and February. Is the volumes aren't there. You don't really have true price discovery during the day, and it's causing a lot of volatility.
Yeah.
So the next thing I have is market sentiment. So this was a post by Lawrence Sauter, and he posted this tweet, and the date of the tweet was last week. It was last week. So market mood, he says, to borrow a term, investors are now convinced that the stock market has decided to invade into bear market territory. Interesting to note how rare it is for bullish sentiment to drop this low. And he put, this is a combination of monthly averages of the American investors survey, individual investors, and another actual sentiment survey. The reason I'm showing this, and this chart will be in our show notes, these things tend to be contrarian indicators. When people are this bearish and positioned this bearish within their portfolio, that's typically, the selling's been done. So when you, at the beginning of the podcast, were discussing that, if some of the events that you're seeing today is going to want you to emotionally take action, statistically, a lot of that's probably baked into prices, as you and I were discussing. And this is one of those type of indicators that if people are really that bearish, they've already sold, they've already positioned appropriately, they've hedged, and it means a lot of that carnage on a short-term basis could be priced in or overly priced into those names.
Right.
I like watching sentiment. It's very bearish right now. I mean, the correction we've had, it feels in the marketplace
Feels a lot worse.
It feels a lot worse. I mean, Mark, 10 to 15% corrections, they're not abnormal.
No.
In the mere fact the last couple of years we haven't had them as frequent makes it feel worse. Anything you want to add to that?
No, it's just, that's what I've been telling a lot of people, is it feels a lot worse than it is, because these sell-offs have happened less and less frequently, as opposed to 10 years ago where it happened a couple times per year.
People were more used to it.
Right.
Right.
So it just, like anything with markets, people have a very short memory when it comes to volatility, I think. And it's a part of human nature, right? It's, to a certain extent you can't control it, but just be mindful that, and I think it feels worse because it's like, it's coming right in the first 2 months of the year. So everyone's like, 2022 is shot. It's going to be a horrible year.
Yep.
But again, compare it to March of 2020. No one in their right minds thought
the market was going to end positive that year.
Yes. When markets were down 25, 30% at their low point, everyone was like, there's no way this thing finishes in the green. it's exactly what happened.
And it did.
So,
well, as we kind of round it out, Taylor Ledbetter is going to be our guest for the financial planning topic of the week here in a moment. Anything you kind of want to end on yourself before we transition to that segment?
No, I just think that, during these times, it's normal to have certain feelings about your investment portfolio and having the urge to sell and go to cash because that's a
take some
safety
action.
net. But, I think you need to check the emotion at the door and know that, you have a long-term game plan. This stuff happens, and to enjoy the long-term above average returns that investors do in the publicly traded markets, we have to go through times like this. And, this isn't going to be the last time this happens. This is going to happen again. Don't know when, don't know how long it's going to be. But this stuff happens, and we just got to be patient with it.
Well put. I have nothing to add to that.
Okay. Well, I'm going to bop out of here and let Taylor come and talk about the financial planning topic of the week.
All right, Mark, we'll see you next week. All right, listeners, our guest this week is Taylor Ledbetter. Taylor has provided our financial planning topic of the week the previous 2 weeks, and we've garnered a good amount of feedback, very positive feedback, Taylor, from some of the topics that you've been covering. And here at the firm, you handle all of our financial planning and paraplanning work. So, as clients need retirement projections, as an example, this is a lot of stuff that you do on a day-to-day basis for our client base. So I think it's very appropriate that you share these topics. So what have you selected this week for listeners?
Yeah, so this week I kind of want to continue on with my tax trend.
Okay.
But instead apply the capital gains rates to real estate instead of investments.
I
we've been
like that.
covering.
Okay.
Yeah, and I'm also going to touch a little bit on what's called a like-kind exchange. I don't think that's a term that's commonly used, so I thought it would be a good education moment.
Let's do this.
So when you sell a home, the IRS allows you to exclude a certain amount of that gain. But to qualify, you must have owned and lived in your home for 2 out of the 5 years prior to the sale date.
Got it.
So those exclusion amounts are $250,000 if you're single and $500,000 if you're married filing joint.
Got it. So if it's anything in excess of that.
Yes, correct. And I have an example to go over as well.
Okay.
So if you bought a home 10 years ago for $200,000 and you sold it today for $800,000, you would have a $600,000 gain. Now, if you're married filing joint, $500,000 of that gain will not be subject to the capital gain tax, as long as you meet those qualifications of living in the home and owning the home for that 2-year time frame.
Got it.
So there are a few factors that would disqualify you from this exclusion, and those include if the house was not your primary residence, so if it was a vacation home, for example. You owned and lived in that property for less than the 2 years in that 5-year period I mentioned before.
Okay.
You don't qualify if you claimed this exclusion on another home in a 2-year period. So say you sold a home about a year ago and now you're selling another one.
Yes.
You can't qualify twice.
Got it. So you can only do that every 2 years.
Correct.
Okay.
Yep. You also don't qualify for this exclusion if you bought the house through a like-kind exchange in the past 5 years.
Okay.
Yep. Have you heard of a like-kind exchange
I think
before?
I know a little bit about it, but I'd be speculating on the exact details.
Yeah, so I actually did a scenario recently for a client with a like-kind exchange, and I thought it was really interesting. It can get pretty detailed, so I'll try to keep it generic because you know how these things can be
There's a lot of nuances, right? A lot of details.
Yeah, so a like-kind exchange is used when somebody wants to sell an asset and acquire a similar one of equal or greater value, and this defers the capital gains tax. So you're basically selling a piece of property acquiring a new one that's very similar, and it allows you to avoid that tax.
So it'd be like selling one commercial building and buying another commercial building.
Correct. And I think it's important to note that taxes under this exchange are deferred, they're not eliminated.
That's a big point.
Yeah, so eventually you will have to pay that tax.
Yeah, you're going to pay the piper at some point.
Now, here's the big catch. Any real estate except for your personal residence is considered like kind to any other real estate. So you can't use your personal residence in this kind of exchange.
It has to be investment-oriented
Correct.
properties.
Some kind of rental or maybe even a vacation home, because that's not considered your primary property.
Got it.
So there are a few considerations to keep in mind to ensure that you don't have that tax liability upon the sale of the asset. So first, as I just mentioned, the asset sold must be an investment property, cannot be a personal residence. The asset being purchased with the proceeds must be in the same asset class, which we mentioned as well.
Yeah, it sounds like you can't go commercial to industrial or industrial
Correct.
to residential.
Correct.
Okay.
Yep. Now, this one is really interesting. The proceeds from the sale must be used to purchase the next asset within 180 days.
That's key.
Yes.
And in the real estate world, that's not exactly a lot of time.
No, not at all. And you also have to identify that property or asset within 45 days.
Okay, so all right, this has to be thought out. You can't just try to do this on the back end to save taxes.
No, there's a lot of kickers to it.
All right. And again, that's not a lot of time in the real estate world.
No.
I know recently, Taylor, that timelines have really gone up as we have more cash buyers in the market. Supply has dwindled. But, things will revert back. And, that's not a lot of time.
Yeah.
Yes, you really got to plan this out.
Oh, yeah. And I think in a time like this where the housing market has been crazy over the past few months, doing this kind of exchange.
Oh, my gosh, it'd be so hard.
Wouldn't it be the best idea?
Because what happens if that property falls through? What happens?
You have a huge gain
exactly.
on your hands.
Yeah. I mean, you got to think about all that stuff.
Yeah.
Okay.
So just to kind of recap over the advantages and disadvantages, like I said, no taxable event as long as the asset is being replaced within the same asset class. This one's really interesting. The IRS sets no limit on how often you can do a 1031 exchange.
They don't.
Which can be a little confusing because when I mentioned the exclusion part of it, you can only do one 1031 exchange in a 5-year period to qualify for that exclusion on the sale of a home.
Yes.
But when it comes solely to like-kind exchanges, there's no limit.
Doesn't apply.
Yeah. But this allows money that you would have used to pay taxes to be reinvested into more property.
Interesting. I do know that there's been some criticism, in society in general, because this has gotten, I think, some publicity that you can move from one property to another, and obviously the intricacies that you mentioned, but kick the can on taxes. I'll be curious if at some point any sort of legislation is changed down the road that maybe starts to limit the frequency of this. You can only do this once every 5 years or once every 10 years, or it'll be interesting.
Yeah, I was, when I read that, I was really surprised that the IRS had no limit on it. So.
That's crazy. Okay.
This last point is actually interesting too. Since capital gain taxes are deferred, so are losses. All losses within a like-kind exchange must be carried forward.
Wow. That's a big point.
Which makes a lot of sense, but that never came to my mind until I was doing some research about it.
No. So let's kind of give like a hypothetical on this. Let's say in the early 2000s, and it'll be a full kind of real estate cycle, things were gangbusters. So let's say someone exchanged a property multiple times, exchanged the last one in 2006, and let's say that exchange value was $500,000. and let's say that they're carrying an unrealized gain of 300. 07, 08 real estate correction comes into play. They go to sell that property, and all of a sudden the property is only worth 100,000. They have to roll that loss forward. They can't realize it.
Yep, as long as it's a like-kind exchange.
Wow. That's something that's notable.
Yeah, no, that's why I included this this in here, because I just thought that was so interesting.
I mean, it makes sense, as you kind of indicated a second ago. It makes sense why they do it, but that's something that's probably glazed over, and that's a very key point.
It is, definitely. Those are all the advantages and disadvantages that I had regarding the like-kind exchange, but, you know, I've only heard this term a couple times, maybe, while being, you know, at the practice. And
see, I generically knew it had to be a same type property. And what I was not educated on is all the other details you mentioned.
Yeah.
Right?
I think one of the biggest factors is the time frame that this has to be done.
That's tight.
That's probably a make or break for most people.
Those are aggressive timelines.
Yeah.
45 days to identify, 180 to close, especially like in this environment, right? You know, because not all these transactions are going to be done on a purely cash basis. And with underwriting requirements where they're at post great financial crisis, they're not easy. And all of a sudden, you know, it takes, okay, it's going to get delayed. We need another appraisal, or we need this, and you're getting close to that 180. That could be dicey.
I feel like a lot of them may just fall through.
Oh my gosh.
During the process.
That's a really good topic this week, Taylor.
Yeah,
I appreciate you bringing that up.
Yeah, I enjoyed looking into it, and, you know, I'm continuing the tax trend, but just wanted to focus on a different area.
Love it. Well, Taylor, you've been doing a great job with our financial planning topic of the week. I know we'll definitely have you back for more in the future. Response from our listeners has been great. So thank you for you putting in the time and effort to prepare for today.
Oh, yeah, no problem.
All right, listeners, we'll be back next week with another episode of the Independent Advisors Podcast. It'll be episode 139 next week. We hope you have a great weekend, and we'll be talking to you soon.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.